Hello guys, what's up and welcome to my YouTube channel. This is Milglean. If this is the first time you're coming across this channel, kindly subscribe, like and share our videos. So Milglean is an accounting and bookkeeping enterprise that does bookkeeping and accounting tax for clients. So you can also reach out to us on any accounting or bookkeeping task or job that you have for us, and we will deliver effectively and efficiently. So today we're going to be talking about internal controls. What are internal controls? We're going to be looking at the meaning of internal controls, the examples of internal controls, and how important these internal controls are in our organization. So we all know that organizations put in place internal controls to help mitigate against every form of financial risk that occur in an organization. So please stay tuned to the end of this video, and we promise you we're going to give you a lot and you're going to learn a lot about internal controls. What are internal controls? So internal controls are policies, processes and procedures that are set by management to achieve the following. So the various objectives they want to achieve by setting these policies and procedures are: one, they want to achieve reliability of financial reporting. They want to be rest assured that the financial reporting are all correct, the records are correct. Then number two, they want to achieve efficiency and effectiveness of operations. Then number three, they want to achieve compliance with laws and regulation. Then the last one, they want to achieve safeguarding of assets. They want to ensure that all assets are secured. So these are the reasons why these internal controls are set in place by management. They are just policies and procedures that are aimed to achieve those four aims. So we'll also look at types of internal controls. We have segregation of activities. In every organization, it's important that their responsibilities and their tasks are divided, or they are shared among employees. It's very wrong in an organization for one person to perform many tasks. Like, it's performing the role of an accountant, it's performing the role of a driver, it's performing the role of the operations staff. It's very wrong. So that's why in all organizations there are responsibilities that you are given, so you'll be accountable to those responsibilities. And in terms of finance, so what the ideal thing is that in every organization, especially the finance department, so we have someone that is in charge of the custody of financial assets. That is someone that is in charge of that is holding money, that keeps money in the safe. That person should be different from whoever is receiving the money. So maybe in an organization now we have the cashiers or whoever receives money from clients. So at the close of business, that cashier records and collects those cash and hands over to the accountant. So the accountant will be responsible of keeping that money, and there will be someone else to pay that money into the bank. So all this division and all this separation of activities, they help to safeguard financial assets. They help to make sure that fraud is minimized to the barest minimum. So that's the essence of all these internal controls. Segregation of activities is a very important aspect of internal control that every organization should do, and it helps to mitigate against financial risk, because the person in charge of custody of financial assets is different from someone that is recording those activities. So just imagine, let's just revise a scenario in our head and think about something that, okay, someone collects cash, still the same person records the amount on the record books, same person goes to the bank to deposit, same person sends reports to management. So are you seeing that it doesn't really go well? It doesn't go well at all, and it's going to give room to a lot of fraud, because only that person handling this process can easily alter the records, and management might not even be aware, because there's nobody that checks, there's no supervisor that checks to ensure that what was money that was recorded tallies with what was actually collected from customers. So you notice in the supermarket, they have strong internal controls. You go to the supermarket, you pay your cash over the counter to the cashier. When you are leaving, you drop your receipts at the entrance with another staff. The person is checking what you bought. The person is cross-checking with your receipts. That is another form of internal control. So it will be very difficult for financial frauds to go on in that organization. At the end of the day, those cashiers, they go and remit all cash that was collected to the accountant, and there's someone else that's in charge of depositing into the bank. So these are strong internal controls that organization carry out to make sure financial fraud is reduced to the barest minimum. So we have another internal control, which is physical control of assets. In every organization, there are some documents and there are some assets that should not be in the custody of every staff in that organization. If not, a lot of fraud is going to take place. Like we have the vouchers. Not all staff should have access to a voucher. Not all staff should have access to a voucher. We also have the seal and the stamp. Not all staff should have access to this seal and the stamp. It helps to control theft, and it helps to control fraud. And also, we have cash. Cash is a physical asset, the financial asset. All our staff should not have access to the physical cash. The cash should be kept in a safe, and the custody should be kept. Only one staff should have access to this safe, should have the passcode to that safe. So physical controls of assets is also another internal control procedure that is carried out. And also we have the third internal control procedure we have, or policy that we have, is authorization of transactions. So in an organization, before any purchase is made, it must be approved by management. So there should be someone in charge of approvals of all transactions. So when a request is initiated, so the requesting officer raises a voucher and submits it to management for approval. And when it's approved, someone else, which is mostly the finance officer, makes disbursements when there is a need for disbursement. When it has to do with inventory, so the requesting officer makes requests and it's approved by management and it's issued by the storekeeper. So this authorization process, it helps to reduce fraud and theft to the barest minimum. So another very strong internal control policy that we have in place is physical audits. So in terms of inventory, some organizations, they do it monthly, some do it quarterly. The storekeeper is audited from time to time. So what they do is that they'll check the record books and they do a physical count to make sure that what is on the record tallies with what is physically present in the store. So that is another strong internal control policy or procedure. Then the last internal control policy or procedure we'll be talking about is reconciliation, bank reconciliation. So every month it is important that the head of the finance department carries out of bank reconciliation. So the bank reconciliation is done by comparing the books, the records in the books with the bank statements. So you're going to check your bank statement to check all the transactions that occurred in that your bank statement, and you're going to compare it with your what you recorded in your books. Obviously, you know that there's some things like bank charges will not be recorded in your book because you don't have access. The bank is the one charging directly, so there will be difference in terms of bank charges. And also the loans that are yet to be, the money that is yet to be lodged into the bank will be different because you've already recorded in your books that, oh, we have collected money to deposit, but in your bank statement is yet to reflect in your bank statement. So it depends on when you print out your bank statement. So these are things you have to check. When you check your bank statement and you're seeing some difference in your books, you're supposed to check why there is a difference in what you're going to investigate. This difference, and this is what we call a bank reconciliation. So after investigating, you do a bank reconciliation statement. So you're going to compare your cash book, you're going to compare your bank statement, and you tell us why there's a difference. You show these differences. If it's difference in bank charges, you're going to show the amount of bank charges for that month. So these are strong internal control procedures and policies that organizations need to adopt. And the importance of these internal control policies are: one, they help to safeguard assets. Once you have strong internal control policies, fraud will be mitigated to the barest minimum. There will be less incidents of fraud, and it helps to make sure operations are effective and efficient. Everything is going seamlessly and smoothly because we have responsibilities are being assigned to staff. The staff know their duties, they know their responsibilities, so they know when they are accountable to certain things. So these are important reasons why internal controls are so important in every organization and every business. We must implement strong internal control policies. So as business owners, it is important to know these internal control policies that you can adopt in your organization to help mitigate risks. So thank you so much for staying to the end of this video. We are really grateful, and just drop your comment on this comment section if there's anything you want to know about internal controls, and I'll be more grateful to respond to your questions. So thank you very much for staying to the end of this video. This is Milgleam, where we enlighten you on financials in an organization. So if you have not subscribed, what are you waiting for? Just hit on the subscribe button, subscribe, like, and share this video. So bye till the next time we see.